five categories of mutual funds in altogether, which has been introduced by SEBI: equity, hybrid, debt, solution oriented, and others. So these are the five broad categories in which the mutual funds have been divided. And this classification was given by SEBI in way back in 2017 to streamline the mutual fund industry. Now, instead of investing directly into the stocks, am I audible? Okay. So I was just saying that, whenever you invest
Yes,
your
sir.
money in equity market, particularly, or any asset class, there are two kinds of risks which are always you are grappling with. One is called the company specific risk or asset specific risk. Like, when I invested in Maruti, there's a strike, and which was, the other companies didn't got impacted because of that. Only Maruti share tanked by 50%. Okay. Whereas, the other risk is called the macroeconomic risk. Sometimes if there is a recession, okay, if there is a downturn, then most of the stocks will fall, but with different kind of a trajectory. Similarly, if something happens because of the GST reforms or because of income tax, kind of thing which happened, that there was a lot of benefit which were given because of the new scheme. So the macroeconomic factors risk is one risk, and the other risk is called the company specific risk. And altogether, it's called the total risk. Okay. So the entire risk which you take is called the total risk. It is divided into two parts. One is the company specific risk or the asset specific risk, and the second one is called the macroeconomic risk, which is also called the market risk. Okay. Now there is a measure through which we can calculate the risk. There is a. So let me just open. Let me open the mutual fund file. So there's actually. Okay. So as I tell you, there are two kinds of risk. One is called what? So both the risk, if you can just define, Shishti, what are the two kinds of risk you take?
So one is firm specific risk you have said, which
So
is
one is
which can't be
for firm
can
specific
not be
risk you had
diversified.
No,
said,
which can be
which
diversified.
is
If
which
you
can't be
invest in,
diverse, which
say, 20 stocks,
can
so
not be
you're diversifying away
diversified
the
away.
company
No.
specific risk. Okay.
Yes, it
Yes, that
can.
is the
Sorry, sorry, sorry.
unsystematic risk. The second
Absolutely.
is
Absolutely.
systematic risk, which is
Yeah, that is
again
the
a beta,
unsystematic
which
risk. The
cannot be
second
diversified away.
is
This is
systematic risk, which is
Absolutely.
again a
So
beta,
you're
which
absolutely
cannot be
right. The risk
diversified
which
away
is
since
called the
it's the
market risk
macroeconomic risks
cannot
that
be diversified
industries
away.
have.
Okay. So when you are invested in a portfolio, so you make your return because of the market risk and not because of the company specific risk, or you said unsystematic risk. Okay. So you make your earnings, or you make your kind of returns only because of the market risk. Okay. And if you have to measure the risk, there are two things through which we can measure the risk. The total risk is measured by way of standard deviation. Okay, I'll talk about that later. And the market risk can be seen through the beta. So higher the beta, so higher the market risk. The stocks which are having higher beta, like the market beta is 1. So if the stock is having more than 1 beta, that means it is riskier than the market. And the stock which is having lower than 1 beta is called less riskier than the market. So, for example, if I say Hindustan Unilever, is it having a beta more than 1 or less than 1? Any guess, Shishti? So, if I say, Nestle or Hindustan Unilever, so is it will be riskier? The beta will be more than 1 or less than 1?
So I think less than one.
Actually, yeah, it's okay. What
So I
you're saying
think
is
it's
right.
less than one.
When you look at the company, you can immediately know whether the beta is more than 1 or less than 1. Now, the trick is like this: if the company is in, is a consumer discretionary industry, that means it is manufacturing and selling goods where we use our discretion to buy it. For example, Maruti Suzuki, it is manufacturing cars. Okay, so we buy cars only when we have money. Okay, when we don't have money, when there is a lot of uncertainty in our job or in the economy, then the car sales drop. Okay, and and whenever the economy does well, and the car sales go up, okay, so where we use our discretion to buy the products of a company, and those companies will always have higher beta. Okay, not talk about a hotel company like Oberoi Hotels. Okay, will it have higher beta or lower beta?
Higher.
Okay, and let's talk about airlines company. Will it have a higher beta or lower beta?
Higher.
Higher beta.
Okay, so let's talk about FMCG company like Hindustan
High
Unilever. Will
beta.
it have lower beta or higher beta?
Lower.
Okay, let's talk about pharma companies like it will have lower beta or heavy beta?
Lower.
Higher
Lower
beta?
beta.
Lower beta. So it is basically the type of business which determines
Lower
the
beta.
beta. So if you have to understand whether the beta is high or low, look at what kind of business it is doing. If it is doing a business where it is manufacturing or selling consumer staples, the goods which are of a daily use, or we consume them irrespective of the state of the economy, then those companies will generally command a lower beta. Okay, the companies which have are riskier, because there we use our discretion to buy them. Particularly a company like Tata Motors, which is manufacturing Land Rover and Jaguar, which are very high end cars, or Mercedes companies. Mercedes companies will have high beta or low beta.
High beta.
Okay, so fine. So basically, it is the beta is
High
dependent
beta.
upon the type of business what we do. Okay, that is one factor. Okay, we'll talk about more about the other factor which affects the beta. Okay, so now let's talk about this mutual fund. So last time we covered, these are the four kinds of mutual funds, which are, 12 kinds of subcategories are there. Okay. So what I'm doing is that I'm just opening, a chat GPT where, I have done some analysis. So I'll just show you that. So it will be available here also because, okay, it's saying login. So this is actually my wife's, this thing. So can you see this chat GPT on the screen?
Yes, sir.
Okay. So now, there are
Yes, sir.
lot of funds, there are about 12 categories. Okay, fine. So the first one is called multi-cap. Okay, so we'll talk about that later. The second is called the large cap. Okay, so large cap we have done. Basically, just to repeat, can you just read this, Shriti?
Yes, sir. Large cap. Primarily invests in well-established companies with large market capitalization.
Yes,
Top
sir.
100
Large
companies by
cap.
market cap.
Primarily
More
invest in
stable
well
compared to
established
MIPS,
companies with
smaller
large
cap
market
funds, less
capitalization.
volatile but
Top 100 companies by
potentially
market
relatively
cap.
volatile.
More stable compared to
Conservative
mid
investors
small
looking
cap
for steady
funds. Less
returns and low
volatile,
risk.
but growth
So basically,
potential
large
is
cap
relatively
means the
moderate.
top 100
Conservative
companies
investors
of
looking for
India
steady
in terms
returns
of
and
market
lower
cap.
risk.
So those companies are going to grow, but the risk is less compared to the other caps. But the return will be not that great as compared to the mid cap and small cap. So large cap will be basically investing in top 100 companies. And if you don't want to take much of risk but still want to invest in equity market, but of course risk is there, but then go for large cap. So whenever the like January onwards, the people were saying that put your entire money in large cap. So move out of mid cap and small caps because they have run up a lot of, they have given a lot of return in the 1 year, like 50-60%. So maybe that they will correct. So large caps were people have moved to large cap. Then we have large cap and mid cap. Okay, so large cap and mid cap is basically investing into all 250 companies of India, 100 large and 150 mid cap. Okay, so if you look at a screener here and say large and mid cap, large and mid cap. So this is the large and mid cap. Okay, are you seeing this?
Yes, sir.
And tell me, what is the return these mutual fund, sorry, this index has given
Yes, sir.
in last 10 years, CAGR?
15%.
And what is the full form of CAGR?
Compounded.
15.3%.
Okay, so that means if you have put your money in mid caps, in the last 10
Compounded
years,
annual
they have
growth
been
rate.
giving 15.3% return. Okay, fine. And if you were invested, your same money in, say, for example, large caps. So large cap. So we say BSE large cap in this case. So how much return you're getting in large caps? Of course, 10-year return is not there. Look at the 5-year return. How much you have got in large caps? Shrishti? Or anyone? Mahalakshmi? Ranjana? Ashwini? Ashwin? Anyone who is present? How much return you have got? Huh? I can't hear you. Anyone?
Yes, sir.
Hello?
Yes, sir.
How much return you have got in last 5 years if you have put money in large cap?
17.
Yes, sir.
And how much if you have invested in top 250 companies of India?
17.2%.
Because 10-year figure is not there, so we are just comparing the 5-year number. So
For
which
5 years,
companies have given
23.3.
more return? Is it the top 100 or the top 250?
Top 250.
Because it contains the mid caps, which grow much faster, but there is a risk
Top
involved in
250.
it. But over the long period, that risk goes off, and you get a higher returns. Fine. So if it is, we talk about the 250 companies, then if you look at so these are all the 250 companies. It includes the top 100, which are large cap, and the this thing. Okay, so we were doing the chat GPT. Okay, so the large and mid caps. Okay, so whichever where your money is put into